All right, gang. In this strategy session, we're going to cover the put credit spread. Now, this strategy here has a lot of names. You may hear it referred to as the bull put spread or the short put spread. I like to call it the put credit spread. What's important to understand is that it's a bullish strategy, which is executed on the put side of the options chain, and you will receive a credit. Okay. Now, this strategy is really awesome. I recommend it for beginners and advanced traders. This is our bread and butter, so it's really important to pay attention to this class. You will be using this strategy very often, and you're going to love it. Okay, so the thing about this strategy here that it may seem a little complex when you first start it, but this is the basics of all the other more complicated strategies. So you got to understand spreads before you can get into like iron condors and things like that. So it's still a basic strategy. The beautiful thing about it is that it's easy to manage. Unlike the other strategies where you have all these variables that work against you, a lot of those same variables actually work in your favor on the put credit spread strategy. Okay, so time is something that's going to work in your favor. Direction, if you're not good with direction, you don't have to worry about it. This is the strategy for you. So the put credit spread is going to allow you to make money, whether the stock goes up, if it goes sideways, even if it goes down just a little bit. If it go down a little bit, you can still make some money, as long as it doesn't go down a whole lot, okay? So you have direction that is in your favor with this particular strategy. In fact, what you're pretty much betting against is that it's not going to move beyond a certain point, which is easier for anybody to basically do because we have the math and our trading platform that's just going to guide us here. So let's actually get into it a tad bit here. Again, ideally, you want to see volatility high, and you expect the volatility to go down as far as volatility concerns are, because this is going to be a sell strategy. Remember, we're receiving a credit, which means that we're selling up front. So we're selling to get into the strategy. We're selling to open. And because we're selling to open, that means we got to buy it back to close it out, basically. But I like to execute this strategy under 60 days. So when you go to your options chain, where you already have your outlook on the underlying stock, in this case, we're using Apple as always. And we have a 40 monthly strike here. It's 40 days to expiration, the 19th of June. And we're just going to click that, open it up. All right, I got 30 strikes present. So we can actually see a little bit here. Let's move it up. All right. So when we actually execute this strategy here, you want to execute this strategy out of the money on the put side, okay? You always execute it out of the money. And the outcome, you want this to expire out of the money, because everything that's out of the money will expire worthless. Okay, so we're selling to open. That means we're going to receive a credit. And when we buy it back, we hope that it's worthless, because you can buy it back for worthless. That means you're buying it back for free. You're getting it for free. And in fact, when you're actually executing this trade here, you will be able to get out of it for free also. So remember, there is a cost of trading. Yeah, that's your commissions. Fortunately, today, commission is 0. However, you do have to pay for each leg of the trade, which is 65 cents with TD Ameritrade currently at as of this recording. So with a single leg trade, right, you have 65 cents to get in, 65 cents to get out for the leg. In this case here, we're using two single trades, two single options, basically. We call them single legs. So that's 65 cents a piece. So 65 plus 65 is going to be $1.30. That's your cost of, doing this trade. Now, you don't have to do any math in your head, because the platform is going to tell you these things. I just want to give you a little heads up on how this works. So what I'm going to do is I'm going to actually show you guys a little bit about the mechanics of this trade, how it works, and then we'll go into executing so you can actually see how it works. So what I'm going to do is I'm going to go to the, let's go to the 280 strike, which is out of the money. Okay, the delta's 17. So I'm going to go here and I'm going to sell, which is, I'm going to sell a single leg strategy, right, which is this 280 strike. And if we sell this one here, which I'm going to go to the analyze trade so we can just analyze as if we're selling it. This is going to be the naked put, all right? So the naked put strategy, if you guys remember this class here, this is not something that we advocate you to do. Now, people do it, but this is something that we don't do, and this is the reason why. If you take a look here at the analyze tab here on the P&L graph, you can see that the loss is substantial, okay? Your maximum profit is very small here, because it's the credit that you receive, okay? And so you're taking a look at a credit of, was it $300 some dollars? Yeah, $319 as we go, $320. So $320 and go to the right, we can see it. But you're risking thousands of dollars. Look at that, 10,000. I mean, it's off the map. So it's too much risk in that strategy. That's why we don't advocate for it. Okay. So ideally what you want to do is to be able to have some, definition to your risk. You want to define your risk better, and you can't do that with this particular strategy. So what you want to do is, because you're selling here, this naked put, to actually make it, to put some clothes on it, we're going to buy back, I'm going to buy back a lower strike here. Okay. So we always sell the higher strike, but we're going to buy back the lower strike for protection. So we're going to go here and buy the 270. And I hit buy, and I'm going to hit the analyze trade as if we're, in this position. And we can see how it impacts the strategy. So if I take that off, you can see that it's back naked. Put it on. Now we have clothes back on. Okay. And so what happens in this case, if you were going to put this on naked, you might as well put it on with some protection. Okay. Because the max profit is still the same. The max profit is still out there, but the max loss is limited. Okay. So in this case, you're only risking $896. Okay. So now you have some definition to your risk, right? It's not almost unlimited. So we don't want that kind of risk. So therefore we are actually buy back, some protection for this particular strategy. And this is how you get the vertical spread. So, we don't execute it this way. I just want to show you this is what it's made up of. And the platform, you're going to tell the platform in one command that you want to execute both of these legs as one single order. And it's going to be executed as a sell order. So let's go and do that here. Okay. All right. So I'm going to go here. We're going to sell the 280 strike. And we're going to actually select vertical. Select the vertical. And then we're going to actually just arrange these here to what we're looking at. So I got the 280. I'm always sell the higher strike. Remember, we're going to sell the higher strike. And then we're going to buy back the lower strike, which is 270. Okay. Now, before I actually execute this, I do want to actually cover this with you real quick. When we put this strategy on, we actually are paying attention to the expected move, right? The platform, as options traders, we do have the math in front of us. We got 26 points expected range here. This is the standard deviation, right? So we have a plus move and a negative move, right? Which that plus move, it'll take us to about $336. So let's go down just a tad bit so you can see that. So $336 around, here. So it shouldn't go above 340. So it's within that range of 340, basically. And on the downside, 283 and some change. So 283. So it's about from 340 to a 280 range here is where this should be moving. Okay. So we have the math on our side. And the reason why I chose a 280 and a 270 strike here, the 280 is the sell here, is because as long as this strategy here, as long as Apple does not fall beneath 280 by the time it expires, which is 40 days, we are going to make money. Okay. And you're going to keep the whole entire credit that you receive, 100% of profit. So that's a beautiful, beautiful thing. So I just want you guys to understand that's what I mean about direction. As long as this thing, by expiration, as long as Apple is not under 280, which is the sell strike, we're going to make money. Easy enough, right? So let's just take a look here at our, we're going to hit confirm and send, and we're going to take a look at, the specs on this trade here. All right. So you don't have to do any math. Okay. But just in case any of you guys want to be geniuses out here and do the math, because the platform does it for you. Okay. Well, we take a look at our break-even stock price here. It's telling us by expiration, the stock, it breaks even at 278. So if Apple moves to 278 and 90 cents by expiration, that should break even basically. And basically how they're coming up with that math, you're just taking the sell strike that we have, which is 280. Okay. And then you're going to subtract the $1.10 credit from it. And then that's how you get the 278 and 90 cents break even stock price. That's the math. The max profit here is going to be, because it's the two single legs that we have here, we just take those, I got them right here. You just take look at the mark price here at 3.226. That's how much that costs to sell. And then you buy back at $2 and 2.120. You just subtract those, you net those out basically, and you get the 110 times 100 shares. And then you have $110 max profit. Okay. So that's how you come up with that. And then the max loss is $890. And basically what you're going to do is take the width of the spread itself. And in this particular one, we have 280 strike minus a 270 strike. That's 10 points. So it's 10 wide strategy here. And because it's 10 points wide, 10 points, times 100 shares is $1,000. We just take the $1,000 and then you'll subtract the credit, which is $1.10, times 100 shares, and that's $110. Anyway, you subtract that, and then you have that $890. So that's how you get your max loss on that. Now, the cost of the trade and the commissions, you got that here. But if you take a look at the cost of the trade with the commissions, you got $1.30. This is the leg of the trades I was telling you about. You got the 280, that's 65 cents. You got the 270 strike, that's 65 cents. You add those up, and you have $1.30. For you, that's your cost of doing business, basically. Okay. Now, the cool thing about this strategy is that if it works out perfectly, you hold it until expiration and it expires out of the money by expiration, you don't have to pay $1.30 to get out of this trade here. The commission will be free. So that's another cool thing about this thing here. So I just wanted you guys to see that on the math side. Let's go to the analyze the profit and loss chart here so we can actually take a look at the Greeks. All right. What I'm going to do is remove the single legs that we got in here because we have the vertical. That's going to tell us what we need to know. All right. So the vertical is telling us everything that we need to know. Under the vertical is telling us that. So we got everything here. If we take a look up here, we can see that if this stock moves up, we're going to make money, right? Anything to the right, we're making money. This little red line here is telling us to break even by expiration. So as long as it's above this line, as long as to the right of this line by expiration date, we're going to make money. Okay. This one here is the break even now. So if it falls, to tomorrow, what have you, and then we're losing some money, but the trade isn't over. Okay. Teeter totter and things like that. But this one here is the break even by expiration. So you can see that there. Anything to the left, we're going to lose money. Okay. Because our risk is defined, we can see that the maximum we can lose on this trade is $890. So it doesn't matter if the stock market crash or anything happens, whatever the worst case scenario that you can possibly think of, we can only lose $890, okay? Now you're looking at it and say, oh, it's $890 is a lot of money, and the maximum profit is only $110 on this particular strategy. So you say, well, that's a lot of risk here. And yeah, you can see it from that perspective. That's a lot of risk just for a small reward. But what I want to do is let me just take you back to the trade tab so that you can see why it's really not weighted as much with this particular strategy, because if you take a look at the probability out of the money, okay, on this one here, we have 80.45% probability out of the money. So the math is telling us that we have an 80% chance of being right, okay? So because the probability of success is so high, it's basically outweighing the max loss that you're looking at. We're going to manage this trade here, and you got to remember the stock has to plummet down to these levels before we even break even, basically, and then some more before we can actually even go to max loss. So all of that is highly improbable, and this is a very high probability trade. Okay, whether you know how to read charts or not, you don't have to with this particular strategy. This is actually good to go. But if you know how to read the charts and everything, and you combine that with this is a very, very high probability of success trade. So let's just go back to the analyze the trade here. All right, cool. So let's take a look at the Greeks. I want to show you guys this real quick. We take a look at the Greeks. We have the delta, which is positive. That just means that the stock moves up. The underlying stock moves up. Our position is going to make money here. So it's delta positive. Now, gamma is negative. So gamma is actually working against the speed of delta. So the acceleration is going to be slowing down with gamma. So if you take a look at, if you execute a long call strategy, because that's a bullish strategy, and this bull put spread is a bullish strategy as well. Well, say the stock moves up. Well, the long call strategy, because the gamma is positive and the delta is positive, is going to move up faster. So that person who has the options on the long call, they're going to make money faster if the direction is right and everything is, in alignment. You're going to make much money. You're going to make more money faster. And if you have this strategy here, the bull put spread, it's going to make some money, but it's not going to make as much money because the deltas are not being accelerated. They're actually moving against you because of gamma. So the acceleration is slowing down, but you're still going to make some money, but it's not as much as the long call, right? Theta is going to really help this position out. So if you're somebody who's working, you don't have time to look at charts all day, this is a perfect strategy for you, because every day that passes by, you're going to make money just by time. Okay. If the stock doesn't move at all, you're going to make money. Okay. So that is a beautiful thing with the strategy here. So it doesn't require you to be staring at screens all day. Vega does work against us here. So as Vega goes up, volatility goes up, it will, negate our position. Again, we want to put this on with high volatility. Volatility is high because the pricing of the options are overpriced, and we want to sell it when they're high with the expectation that they're going to come down. You see this often with like after earnings, or up into earnings, after earnings plays. You see the volatility crush. Oh, that's a beautiful thing for this particular strategy. So you see those kind of positions happening. So let's actually do some execution on this so you guys can get the gist of this thing here. So if we move the price up, let me go and just move the price up $5. If we move the price up $5, we can see our P&L. We just moved up. We're at 23.60% profit. Okay, so that's a beautiful thing. If the stock goes up, that's just showing you that you're going to make money. And if the volatility goes up 5%, that's going to hurt us. Our P&L is negative 25. Okay, now if that volatility was to drop, bingo, we're at 29 plus, right? So we made money just off the volatility dropping. And let's actually cancel that out. And then when we actually go to the time, as time progresses, every day that passes by, we're making money. Look at our P&L. It's making money every day that goes by. So, and the price isn't moving, but you're making money just off of time alone. So this is why I really, really like this strategy, and I really recommend it for, any newbies. It may not seem like it's an easy strategy to execute, but it really is super simple. The platform does all the work for you. So it's super simple to put on, and it's very easy to manage, basically, because you have all these different variables that's working in your favor, as I just showed you here. The only downside about it is that your max profit is limited. Okay, so you have a capped off limited profit potential. But if you want to take in more credit, all you do is just add on more contracts. So if I add more contracts, it's going to actually add on more risk, but it's going to also give you more credit. So if I put on 5 contracts, then my max profit now is $550. On the downside, you are risking, $4,400. Okay, so you definitely want to keep that in mind. So this is the bull put spread. This is